Bitcoin holders are asking one simple question right now. Is this just another pullback, or is something bigger happening underneath the market? At first glance, it looks like a Bitcoin story. The price weakens, traders watch the support zone, ETF flows slow down, and social media starts debating whether Bitcoin is breaking down again. But the bigger signal may not be inside Bitcoin itself. The bigger signal is that macro is starting to take control of risk assets again. When Bitcoin falls by itself, the story is usually about crypto. Maybe leverage was too high, maybe traders were too bullish, maybe funding rates were stretched, or maybe a large holder sold into the market. But when Bitcoin weakens at the same time that technology stocks are under pressure, bond yields are rising, inflation data is back in focus, and investors are questioning whether the Federal Reserve can really cut rates soon, then the story becomes much larger. Bitcoin is not just reacting to crypto news. It is reacting to the same liquidity conditions that move stocks, bonds, the dollar, and high-risk assets across the entire market. This is why the current market feels different. Bitcoin is not crashing in isolation. It is being pulled into a broader macro environment where every investor is watching the same few things: inflation, yields, the Fed, ETF demand, and where capital wants to hide next. In this kind of environment, Bitcoin becomes less like an independent asset and more like a pressure gauge for global risk appetite. When liquidity is easy, Bitcoin can move aggressively higher, but when liquidity tightens, or when investors become uncertain about inflation and interest rates, Bitcoin often becomes one of the first assets to feel the pressure. The first force controlling Bitcoin right now is inflation expectation. Markets do not only care about whether inflation is high or low, they care about whether inflation is falling fast enough for the Federal Reserve to become more supportive. If inflation stays sticky, the Fed has less room to cut rates. If the Fed has less room to cut rates, bond yields can stay elevated. And when yields stay elevated, investors suddenly have a harder choice. They can take risk in Bitcoin, AI stocks, growth stocks, and speculative assets, or they can hold safer assets with more attractive yields. That choice matters because Bitcoin does not rise only because people believe in it. Bitcoin rises when there is enough liquidity and enough risk appetite to support that belief. This is where bond yields become so important. Many crypto investors focus only on Bitcoin charts, but the bond market often tells the deeper story. If yields move higher, the market is saying that money is becoming more expensive, or that investors are demanding more return to hold debt. That creates pressure on long-duration assets, growth assets, and speculative assets. Bitcoin may be different from a technology stock in structure, but in market behavior, it often trades like a high-beta liquidity asset. When capital becomes more cautious, Bitcoin usually does not get ignored. It gets tested. The second force is ETF flow. Bitcoin ETFs changed the market because they created a cleaner bridge between traditional finance and Bitcoin. When ETF inflows are strong, they can create a powerful sense that institutional demand is supporting the market. But when ETF flows slow, reverse, or become inconsistent, that support becomes less reliable. This does not mean Bitcoin is broken. It means the market loses one of its easiest bullish arguments. If ETF demand is not strong enough to absorb selling pressure, then Bitcoin has to rely more on organic demand, long-term conviction, and broader market liquidity. That is a very different environment from a clean momentum phase. The third force is capital rotation. Right now, investors are not only asking whether Bitcoin is attractive, they are asking what asset has the strongest story. For much of the recent cycle, AI and large technology names have captured the market's attention. When investors believe AI can drive earnings, productivity, and future growth, capital flows toward that story. Bitcoin then has to compete for attention and liquidity. That does not mean Bitcoin has no role. It means Bitcoin must fight for capital in a market where AI, mega-cap stocks, bonds, cash, and defensive assets are all competing at the same time. This is why a simple price drop can be misleading. A weak Bitcoin chart might look like a crypto-specific breakdown, but if AI stocks are also under pressure, if equity futures are soft, if yields are rising, and if investors are nervous before inflation data, then Bitcoin is probably not the only asset being judged. The whole risk market is being repriced. In that case, Bitcoin's weakness is not the cause, it is the symptom. It is showing that the market is less willing to pay high prices for uncertainty. For the calm metrics, the key question is not whether Bitcoin is bullish or bearish in one day. The key question is whether the liquidity environment is improving or deteriorating. If inflation cools, yields ease, ETF flows stabilize, and technology stocks regain confidence, then Bitcoin can recover because the macro pressure relaxes. But if inflation stays sticky, yields remain firm, ETF flows stay weak, and capital keeps rotating away from crypto, then Bitcoin may remain trapped even if long-term believers continue to hold. This is also why traders should be careful with emotional narratives. When Bitcoin is strong, people say institutions are here forever. When Bitcoin is weak, people say the cycle is over. Both reactions can be too simple. Markets move through conditions. Bitcoin does not need perfect conditions to survive, but it often needs supportive liquidity to trend strongly. Without that liquidity, every rally can become harder, every breakout can fail faster, and every support zone can become more fragile. So the real story today is not just Bitcoin falling. The real story is macro taking the steering wheel again. Bitcoin is being squeezed between inflation data, bond yields, Federal Reserve expectations, ETF demand, and capital rotation into other themes. That is why this moment matters. If Bitcoin stabilizes while macro pressure eases, then this may only be another liquidity test inside a larger cycle. But if Bitcoin keeps weakening while macro pressure builds, then the market may be warning that risk appetite is not strong enough yet. The calm way to read this market is simple. Do not watch Bitcoin alone. Watch the environment around it. Watch yields. Watch inflation expectations. Watch ETF flows. Watch AI and technology stocks. Watch whether investors are adding risk or reducing risk. Because Bitcoin is not moving in a vacuum, it is moving inside a global liquidity system. And right now, that system is asking a difficult question. Is this still a Bitcoin pullback? Or is macro taking control of the entire risk trade? That is the signal investors should respect. Bitcoin may still have a long-term story. It may still be a major asset in the future of finance. But in the short term, the market does not reward belief alone. It rewards liquidity, demand, timing, and confidence. Until those conditions improve, Bitcoin may remain trapped, not because the asset has no value, but because the macro environment has become too powerful to ignore.